Let's take a look at some of the charts from the latest Bitcoin article on Brave New Coin. As usual, all information is intended as educational and not trading advice. So if we look at a heat map of the UTXOs on Bitcoin, and UTXOs are essentially timestamps of change made when transferring coins. So we can look at all the coins on the blockchain and see exactly when they moved and what date and what block. And then we can give them provenance. We can say there were this many coins percentage-wise based on the circulating supply that have moved within the past week, within the past 6 months, within the past 5 years in the blue case up here. And you'll notice that over the years since 2014, fewer and fewer coins are moving on a day-to-day basis. More and more coins are sort of stuck in cold wallets, hard wallets, or are lost forever and not moving. So this is certainly a bullish scenario because it removes circulating supply, decreases selling pressure over time. It means that there's less and less float, less and less available for trading on the open market, and this leads to volatility in either direction. In general, what we've seen, if you look at the local tops in price, so the black line is Bitcoin price on a log scale. And if you look at the age of coins as a percentage that have moved around these local tops, you can see that when we get spikes in price, we get a higher percentage of coins that have moved recently, which makes sense. People are in profit, people are moving coins to an exchange, people are selling, OTC people are selling, all sorts of people are selling, right? When we get to a local top, or they're buying, that happens either way. But in any case, you can see that during these highs, we've had highs in coins moving at a high percentage on the network. So what we see here is the opposite of that. We're not seeing a massive spike in coins moving over the past week, month, 6 months, year, that sort of thing. I like to look at this from the perspective of helping me decide, is this a local top? Is this a local bottom? Are a lot of people moving coins right now? Another thing you can look at is Bitcoin days destroyed, which sort of shows a similar picture. It shows when coins have been held for a long time, have finally moved, then it adds that to days destroyed. Looking at the hash rate and difficulty, since 2019, you can see we had a massive ramp in hash rate, a massive ramp in difficulty. Q4 2018, we saw a monthly downtrend in hash rate. We did also see a downtrend in hash rate in 2019, even though it was at all-time highs. And now what we're seeing into 2020 is a new all-time high for hash rate, a new all-time high for difficulty. So these certainly aren't bearish characteristics of a network. If more and more miners are adding hash, that says to me anyway that they believe the future of price will support their investment, or the future of price will increase their investment. Can they all be right? I don't know. Will they all be right? I don't know. We'll find out. Another important thing regarding hash rate is that this year Bitcoin will have a block reward halving somewhere around mid-May, April. When that happens, the monetary reward for mining will decrease by half, and all of a sudden, lots of smaller guys or smaller miners will essentially get priced out of the market. They'll no longer be profitable. They can't afford to pay for electricity at that point. And so it's potentially and will cause an increase in centralization. But that's definitely something to look for in 2020 around April and May. If hash rate just blisters past all-time highs, even after halving, that's certainly more bullish, I think, than miner capitulation immediately before halving or after halving, as that sort of points to the smaller guy getting pushed out of the market. They just can't afford to mine anymore. Or they just don't believe in the future of the coin to the point where they can mine at a loss and hope to sell at a higher price later. Another thing that didn't make the article, but I do want to talk about, is the number of blocks per month on Bitcoin that have had only one transaction. So historically, this hasn't been many blocks per month. This is virtually nothing percentage-wise. How does this happen? So in order to get one transaction in a block, you're basically most likely using this technology called covert ASIC boost, which shuts out SegWit transactions and attempts to find a block quicker than anybody else. So initially it was used as a efficiency tool, also as a way to say, I don't want to use SegWit, I don't want to support SegWit from a mining perspective. So over time, we've seen a decline in the number of Bitcoin blocks per month with one transaction, which is good from the health of a network perspective. We don't want miners acting to their own economic advantage. We want them acting for the health of the network, the good of the network. They're just a component that helps confirm transactions. They shouldn't be trying to harvest and strip mine money by trying to find blocks as quick as possible. Even though that's what they're doing, they're finding blocks as quick as possible, but proof of work should dictate that, not some covert software enhancement that is detrimental to the network. So to see this decline is definitely good. It says that the Bitmains of the world are probably not using their technology as much to harm the network. All right, looking at some price charts, I always like to look at Bitfinex long shorts. In this top panel, I like to look at RSI, which is an oscillator. You can use any oscillator. I prefer RSI. I like to find peaks or troughs in RSI, as well as bullish or bearish divergences. We've got the VPVR, the volume profile of the visible range, these horizontal bars. This just shows you the volume at the certain price as opposed to at the specific day. And then I like to look at yearly pivots, which print January 1st every year and are based on the high and the low of the previous year. And from the trend perspective, I like to look at the 50 and the 200 EMA, the 50 being the green line here, the 200 being the red line here. So we'll start with the Bitfinex long short ratio. I like to look at this, again, similar to RSI. Are there peaks and troughs in the long short ratio that can sort of point to things that are happening with price? You know, down here, we were seeing shorts at all-time highs, which tells me, okay, this is a crowded trade. A short squeeze is more likely than ever because more people are short than have ever been. And if price goes up, those people are going to get nervous. They're going to start losing money. They're going to start buying back their short, covering their short, and that's going to move price up. That's a short squeeze. So over the past month or two, we've seen a massive spike in longs on Bitfinex and shorts at an all-time low. Certainly not something I want to see if I'm bullish. I don't want to see longs being in a crowded trade. I don't want to see virtually no short fuel here on Bitfinex for the long aspect. So this is definitely a nervous looking, cautiously bullish picture. Certainly a lot of people think we're bullish here, but not enough people are shorting and giving us fuel for more up. You know, if everybody's already long before price goes anywhere, price doesn't go anywhere. That's basically what I'm trying to say. Looking at RSI, we can see since October we've made higher lows in RSI, which is bullish, with lower lows in price. That's a bullish divergence. It's finally starting to pay off now as we are back at the 200 EMA. We're nearly exactly at the yearly pivot. So one way to play these pivots is from pivot to pivot. So you could logically say, well, if we break above this pivot, we're going to reach for this pivot. That's one way to play it. I like to also see it as a key price level, maybe not consciously in the market, but certainly subconsciously based on highs and lows of the previous year. That level is important. And we're consolidating there, so that confirms my bias as far as being an important level. If you look at the low for 2018, we actually hit the year's S1 pivot, which would be this pivot here, nearly exactly. So whether or not the market knew it was there, that's where we went. That's where we bounced from. If you look at the 50-200 EMAs, we want to see a bullish cross if we're bullish. We don't want to see a bearish cross. If we're about to enter position and we're seeing consolidation, you want to see it about to turn bullish so that you're ready to pull the trigger from a trend metrics perspective. So being above this volume resistance, certainly being above this huge volume node here at 6,500, which was created throughout late 2018, definitely more bullish than bearish. We're just coming off of an inverted head and shoulders, so that successfully played out to the upside as a bullish reversal. So the next step would be to watch this current accumulation period continue to be marked up higher towards 8.7 or 8.888, something like that. Looking at the pitchfork from 2015, this is a bullish pitchfork. It's pointing upwards instead of downwards. This yellow line is created from three extremes in price, which are always extreme highs or extreme lows. And it's saying that the rate of change for this trend has been as such since 2015. For about 2015 to mid 2017, it was pretty tightly bound to that yellow line. From 2017 to 2018, late 2018, you can see it sort of had its Rumspringa and did its thing. This was the bubble at the time, but it came back to that median line. 2018, 2019, it was below the yellow, came back. So all this is just saying to me that this line is real. Again, much like the pivots, it's not necessarily a conscious known thing in the market, but it's a subconscious mind meld that people know, like, this is what the rate of change should be. If we're below that rate of change, we're more likely to return to it. We're oversold. We are ready to get bullish back to it. If we're above it, we're more bearish as we're trying to get back to that mean, that rate of change. So seeing us sort of reconsolidate in the same zone we did in 2018, 2019 certainly gives me bullish vibes as we can return back to this white, green, yellow zone from like 13 to 18K, which sounds weird to say out loud, but that's what the rate of change dictates since 2015. Certainly we can just drop out of this pitchfork, go into the core, break all metrics since that time, but we can't say for certain if that's going to happen until we break out of this pitchfork to the downside. Right now, as long as we're in the pitchfork, you should assume that we will always return to this yellow line as we have since 2015. Looking at the daily cloud, as long as we're above the cloud, we're bullish, as we were much of Q2 2019. If we're below the cloud, we're bearish, as we were for most of Q4, all of Q4 2019. And just now, we're entering the neutral trend decision phase. Price can always go up or down, obviously. When we're in the cloud, it's neutral. It should be a no trade zone historically, based on cloud principles. It can go in, it can go out until it makes a definitive move one way or the other, as it did here. Now, this was a bearish Kumo breakout. If you're bullish going into February, what you're looking for is a price close above the cloud. That would be the first price close above the cloud since August 2019. Definitely a trend shift, a momentum shift. You can see here we have this ascending triangle, bullish flag forming, certainly points to a higher high pending here. Seeing this bullish TK cross tells anyone who is short from this period that it's a good idea to close it. That's what that says. And like I mentioned previously, this inverted head and shoulders broke above the neckline, now into the cloud. So over the past, going into the next month and into February, what you'd be looking for is price closes above this cloud, certainly not below the cloud, and definitely not below the inverted head and shoulders neckline, which looks to be a pretty key area of interest at 7.5. It was an extreme low here, it was lows here. So as long as we're above that, above the cloud, we're certainly more bullish than bearish. Then lastly, again, if we look at the CME futures contracts, which since inception have had quite a bearish pressure on price. Futures started basically at the height of the bubble. The CME people all said, oh, we tamed the market. Well, maybe, but you also launched at the exact peak of the market, at max insanity when Coinbase was going up $1,000 a minute, stuff like that. So that happened. It's interesting now, looking back on that CME options started today, this week on January 13th. So we'll see what impact that has on price going forward, obviously. I highly doubt it will have such a negative impact on price as the futures launch did, simply based on where price is sitting at the moment. Now, we won't know really until mid Q1 this year sort of what's going to happen. Historically, these biannual contracts have all just been up or down. They've been binary. There's been no flippy, floppy, wishy-washy. It's just been one way or the other. This Q3, Q4 biannual contract was just down. This one might also be down. We won't know, obviously, for a few weeks. The previous Q1, Q2 contract was up in a big way. And historically, Q2 has been the best quarter for crypto just broadly all years ever.